So I'm Stefan Dercon. I'm here the director of the Center for Studying African Economies. This morning we are going to start with having Mthuli Ncube here to talk to us. This will essentially be about macroeconomics, and as yesterday was commented, the majority of researchers and indeed of papers at our conference are these days micro. But it's probably not a bad time to get all of us microeconomists reminded that there is such a thing as a macroeconomy, because one thing we can be sure of in Africa in the next 5 years or so, macro will matter. And it may not have mattered that much in the same way over the last 15 years, but I can assure you it's going to be messy, it's going to be tough. There are certain countries where it's going to be quite difficult. Important policy choices will have to be made, and I think all of us microeconomists probably should brush up a little bit on what's been going on macro in the last 25 years. It's therefore also with great pleasure to be able to introduce Mthuli here. Mthuli has had a very distinguished academic career and is still having one. He was the Dean and Professor of Finance at Wits Business School. He was also the Dean of Commerce, Law and Management at Wits. He's probably best known for many of you, or to many of you, as the former chief economist of the African Development Bank. He also has quite a lot of private sector experience as the founding and chairman of the Barbican and Selwyn Capital, is that the name? Yeah, that's the name, and also worked for Investec. So he knows what he's talking about. He's not just telling us all kinds of things about it, but he's done it in practice as well. He made at least one big mistake in his career. That's about 30 years ago, when he was indeed offered a job here at the Center for Study of African Economies. He refused the job and went to LSE. It took him a long time to redeem himself, but more recently we gave him again a job in Oxford, and he's now a professor at the Blavatnik School of Government. So Mthuli will talk for about 30 minutes. There should be plenty of time for asking questions. So Mthuli, the floor is yours.
Thank you. Indeed, Stefan, I've come back, so I've redeemed myself. Colleagues, good morning. Thank you for this opportunity to speak to you this morning on some macroeconomic issues troubling Africa right now. I think Stefan is right that we need to get back and do a bit of macro before it's too late. My talk is entitled Global Growth and Financial Spillovers into Africa. That's just not to say that really all the spillovers are all for, international, global, but also domestic issues going on in terms of policy choices that we need to worry about. But I wanted to focus mainly on the global growth spillovers into Africa. Now, so really in terms of the plan of the presentation, I want to raise the key issues and then take it back to a couple of theoretical puzzles, just to make sure that we're not veering away from theory, and then go more deeply into the origins of the spillovers, the channels of transmission, and the impact. And then I want to say a few things about how it's all impacting monetary policy choices, and then I will say a few things about what I've been doing with about 46 African countries in terms of analysis of the impact of these global spillovers. Colleagues, you all know that Africa has been growing at an average rate of about 5%. It's responded quite nicely to, or rather successfully, to the initial round of policy shocks, but it's no longer the same. Basically, the shock absorbers have been impacted, they've been depleted. In terms of fiscal shock absorbers, I'm not too sure that there's room either on the monetary policy front for a lot of the African countries. So the issue now is, how can Africa sustain this growth in the face of continuing shocks, but also domestic-driven shocks in terms of policy choices. There are two countries that really bother me, and I'm going to spend a bit more time on South Africa. It's South Africa and Nigeria, and how they're responding to the shocks. South Africa is, in a sense, responding to also what the market considers to be political risk. The monetary policy is now trying to manage that risk. We've seen the hardening of monetary policy last week, when the policy rate was raised to 7% in the face of the falling rand. What is about imported inflation? And there we are. But really, political risk is part of the story here. In Nigeria, has gone back, I would say, a couple of decades in terms of macroeconomic policy, if you ask me. A fixed exchange rate, a developing parallel market, and it's not clear to me that the policymakers really focus on fixing this. And I'm worried that both countries may face a downgrade by the rating agencies. I'm just worried that in the next 3 months to 6 months, they will get a downgrade, and that's really not so good for these countries. Basically, for the bulk of the countries in sub-Saharan Africa, you have seen a massive, I would call it a massive issuance of foreign debt in the form of sovereign euro bonds. I think the average pricing in terms of yield was about, 7%. But if the same countries were to go back to the market now, the yield will be of the order of 10% very easily. Risk premiums have gone up. Why? Because some of the countries have missed the commodity cycle, so their macro picture looks terrible. If you look at Angola, Congo, Chad, Nigeria, the picture that doesn't look great right now. So the credit risk has risen quite substantially, and the pricing of any new issues is going to be problematic. Those of you who have been following Mozambique in terms of its issuance, the tuna bond issue, which is now caught up in some difficult explanations as to what happened there. The country clearly is going to go into a technical default, in my view, and they're already talking about restructuring that bond. So it's not looking too great. We've been watching the currency volatility in South Africa, as I've already mentioned, and debt sustainability, is being threatened. If you look at because with the slowdown in growth, and interest rates in dollar terms not really dropping that much. On the contrary, they might go up. That gap between the rate of growth and the interest rate, which is a key driver of debt sustainability, is going the wrong way, and it's threatening the debt sustainability picture of some of these countries. So those are the issues. Really, the issue is how can South Africa sustain the growth trajectory through the appropriate policy responses to these continuing global shocks. These are projections on growth that we thought, but I've since changed my mind on really the projections on Nigeria. I've been doing updates. I now have it sort of 1% lower than that. Angola growth is also 1% lower. Mozambique is also 1% lower. I think Rwanda is maintained in terms of the growth focus from what I see going forward. Cote d'Ivoire as well. This rate of growth for Sierra Leone it is including the Ebola focus. These are some of the fastest growing countries. Still looks like decent growth, but there is trouble ahead. Some of the slowest growing countries, South Africa, Swaziland, Southern Africa generally, Mauritius, and then Morocco, Egypt, Sudan, and then these kind of countries, Cape Verde and so forth. So in terms of flows into Africa, some phenomenon which has been taking place over the last a couple of decades, really the rise of remittances, which now are almost as large as foreign direct investment on average, but also just as large as the official development assistance, all of the order of about $50 billion per annum. Portfolio flows are the lowest form of inflows into Africa, but also they are targeted at countries like South Africa, Nigeria. I think I have Egypt in there as well. It includes the MENA countries, so the large, countries with the large equity markets and bond markets. Now, if I can just link this back to some theoretical puzzles, that there's what you call the capital allocation puzzle. So as we think through these issues, refer back to that. Bob Lucas, way back in 1990, wrote this paper, I think American Economic Review, wondered why capital was flowing the wrong way from poor countries to developed countries. It should be flowing the other way around, because just in terms of the rates of growth, the average rates of growth. And this has been followed up by Gorinkas and Jean, in the last few years. And then also there's the home bias puzzle, which basically says that if you look at the global asset allocation let's say, typical UK or US fund manager, not so much of that portfolio is really invested in emerging markets, even though there's much higher returns and yields in emerging markets. There's still a home bias, a preference for investing those at home. There are many reasons why this is the case. It's risk considerations, sometimes it's regulatory. There are so many reasons, but I just want you to think about these two puzzles in the literature. And then in terms of the book, which really is linked to what I'm going to talk about, is entitled Global Growth and Financial Spillovers. It's just come out. I've been working with two researchers at the Reserve Bank of South Africa, and we've done this book. Now looking at just a few starters facts, basically what we're finding is that if you take the what is called the fear index, which is the VIX, which measures the volatility of the S&P 500 index, it seems to be moving in the opposite direction as the South African equity market. You can imagine when fear is high in the US, capital is likely to flow out and is likely to end up in a country like South Africa. So then capital will flow out into emerging markets when fear goes up. Equally, the fear index is positively correlated with the exchange rate, rand-dollar exchange rate. You can understand why, because any outflows into South Africa are likely to lead to an appreciating exchange rate. Now, there also seems to be some co-movement in asset prices between the US and South African asset prices, but also Europe as well. There's this strong correlation between US bond yields and South African bond yields. I used to do this for a living, and the way the analysts work is that the moment the US yield goes up, just give it a day or two, South African bond yields will also go up, because the expectation is at some point the authorities in South Africa will react to potentially rising US rates by raising interest rates, and then the bond market starts signaling that by steepening the yield curve. And equally, there's a correlation strong correlation between US equities and South African equities. We also noticed that the G7 GDP growth tends to lead South African growth by about 3 to 6 months. So you can almost tell what's going to happen to South African growth by watching what's happening to G7 growth. And there's so many channels. I'll come to the channels of transmission in a moment. I'll skip that. So in terms of methodology, in terms of what I use to try to understand how the channels of transmission work, I use the typical VAR analysis. I don't want to go into the econometrics. I can do it if you want me to, but I'm going to skip that. What I found in trying to understand the channels of transmission is that it seems that US, Japanese growth, Russian growth, and UK growth impact South Africa growth positively. And German and French and Canada growth is not as impactful, but it's still positive. And this I'm getting from the simple impulse response functions from the VAR analysis. It's similar results. I'm going to skip that. It's interesting to note that in 2009, it is actually the UK economic activity which really contributed in large part to South Africa's recession. But also coming out of the post-recession, it was again UK and US which led led South African growth out of that recession in terms of those global spillovers. So UK matters, US also matters in South African growth volatility. Now, just comparing international versus domestic factors, you can see that prior to 2006, prior to the crisis, international factors were really dominant in supporting South African growth. And during the crisis, it is the same factors that dragged down South African economic growth, in addition to reactions to QE1 and QE2. You can see the blue there is international factors dragging down growth, and then Q1 and Q2. So that's right. Now, in terms of but what are the channels of transmission? What I try to do is to test whether, export growth, commodity prices, equity prices, bond yields, the exchange rate, and business confidence are indeed channels through which global growth spillovers are transmitted into a country like South Africa. I also constructed a counterfactual where you just switch off one of the factors and see the impact of that in the normal way that we do counterfactual analysis in this VAR analysis, and then you compare the impulse response functions from the counterfactual and the factor in question. So what I found, for instance, just looking at the impact of US growth only on South Africa, is that quite clearly, if you just follow these blue lines, that trade, the equity market, bond market, exchange rate, and then business confidence index and the commodity channel are all very important transmission channels for growth spillovers from the US into South Africa. So, and this is important. It means that when you're enacting policy, when you're reacting to a shock from US growth, you need to think about your trade policy, the capital markets, any policies that pertain to the capital markets, exchange rate policy, if you want to tamper with that, and what you want to do about improving the quality of business confidence, and then anything you want to do regarding commodity prices. So we know that these are the channels through which this shock operates, and it's very important to know that if you want to implement any policy response. There's also a hierarchy of importance. This is so small. You can see that, for instance, from the now I can't see properly. I have to do this. So small. I tried to fit all these charts. It's still even smaller on this one. So I hope you can see. So this chart is very interesting. Try to order these channels to see which one is more important than the other. Different ones. And then I also tested as to whether there is a third country effect, because some of the shocks are not direct, they're indirect via another capital market. So, for instance, US shocks could get to South Africa through Europe, for instance, or Japanese shocks could get to South Africa through South Korea, who knows? So again, looking at the shock itself in this red line, I'm just simplifying for you and I speak speedily, and comparing that with the counterfactual being the blue, what we're finding is that there's evidence that shocks from Japan, UK, and France are also transmitted through third channels, third countries. So there is a third country fact in terms of the transmission of these shocks. Now, looking at the BRIC countries as to whether any growth shocks are transmitted in South Africa, the answer is yes. Looking at China, Russia, Brazil, India, you can see the persistence there of Chinese shocks, growth shocks into South Africa. Russian shocks tape off at some point, Brazilian the same, but really it's Russia China and India that have more persistent shocks in terms of just the picture of these impulse response functions. The shock from China into South Africa is also accentuated through the commodity channel, gold, iron ore, and copper. You can see that all of these are quite persistent, and the counterfactual shows that they are important, and they do explain, as the channel of Chinese growth into South Africa growth via this commodity channel. Now, as another in the book as well, I try to analyze the impact of capital inflows into South Africa. If you just follow that, looking at the various, this is just portfolio flows, how it impacts different variables in the economy. You can see that it's all relevant, it all makes sense in terms of the economics. I also developed a financial stress index for South Africa, looking at the various banking sector conditions, the exchange rate, and the other non-intermediation financial activities in terms of investments and activities in the equity market and the bond market. And I used the principal components method to create this index and try to correlate it to the real economy, just to understand whether any financial stress in the economy affects the real economy or not. And you know, there's a lot in there. In terms of the components of this index, I've included the measure of equity market risk, and then also the spread, bid-ask spread, as a measure of liquidity within the equity markets in terms of the overall index. And then I included a measure of currency risk, which really is the difference between the normalized changes in the exchange rate and for foreign reserves. The other variable is exchange rate volatility, credit stress. I'm going to run through these. Money market spreads. It carries on, yield curve, sovereign risk, the risk aversion through the risk index. And then I eventually end up with a measure of South African financial stress. And you can see that during this 2009 period, and I use monthly data here, the index really shoots well above the two standard deviation bound. That's quite a lot of stress there. And I want to, you know, and you can see that in terms of the real impact, its impact on the real economy. You can see manufacturing, export, and imports being impacted by this. Also, what we've tried to do in South Africa is to insert the financial stress index into the monetary policy rule. If you're thinking of interest rates being the target here, and then the inflation gap, output gap, and then the interest rate in period T-1, and then this is the financial stress index. Looking at that, and looking at whether monetary policy reacted, you know, strongly enough to this spike in 2009. This is what we found the authorities to be doing, that the reaction wasn't strong at all. So monetary policy loosening in South Africa in response to the shock wasn't strong enough. And we've been saying to the authorities, look, it's high time you started to really think through the use of this FSI in a monetary policy rule. It's also linked in a sense to financial sector stability. There's some sense in which it is, especially if you consider the risk premium, or rather the credit default swap spreads in the FSI. Those would tell you a bit about the stability aspects of the financial system. So I've said a lot of things about where sources of growth into South Africa are coming from, where the shocks are coming from, the channels of those shocks. Is there a third channel of those shocks into South Africa? And also I've explained how and capital inflows impact the real economy, and then finally this financial stress index as a way to again try to understand how the financial sector impacts on the real sector and how that should build into the monetary policy making rule. Finally, I also did some analysis on global spillovers on 46 African countries, and I excluded South Africa in that. And then these are spillovers from 30 developed and emerging markets. So it's 90% of the global GDP. So here I had to use a different technique, not just VAR, but a GVAR, global VAR. So you run a VAR X for each country, and then you try to link them up using the trade weightings, which is a technique that Hashem Pesran et al. Developed in that famous 204 paper. So in doing that, what we find that the channels of transmission are through trade, FDI and ODA, sovereign risk, and liquidity from the 30 developed countries into the 46 sub-Saharan African countries. I also divided the African countries into fragile states, into commodity-driven or factor-driven countries, and also the more investment-driven countries. So you can see, for instance, under fragile states, it could be Sierra Leone, Liberia, although countries don't like being called fragile, by the way. They really don't like that. They are just states. So I think we have to, but any country with a CPIA of less than 3 is considered fragile in terms of classification under AIDA or African Development Fund. And then factor-driven, countries are commodity-driven, investment-driven is all the other that are that. And then what we find is in this research is that any 1% drop in GDP growth in Europe. For instance, when I pulled out just the Europe only, decreased growth in the factor-driven countries by as much as 0.5%, just below 0.5% for the factor-driven countries which are non-oil, but still factor-driven, and then the fragile states about 0.4%, and then the investment-driven countries about 0.3. So you can see that the countries that are being impacted the most by any drop in European growth is really your factor-driven countries, followed by the fragile countries. Factor-driven countries are most connected, of course. And you can see why one wants to care about Europe, because 60% of the trade between Africa and the world is with Europe. In fact, what I show in this slide is that if you look at broader OECD growth, a 1% drop in OECD GDP growth drops Africa's exports by as much as 10%, and GDP growth from OECD countries drops Africa's GDP growth by 0.5%. So the Europe figure plus the expanded OECD figure are about similar. And then looking at the more recent oil price shock, and here I've been trying to be optimistic because I've been reading all these reports from Goldman Sachs and IMF about World Bank about our colleagues about the where we think the oil price is going to be in the next 2 years. This is very optimistic, but I have to believe it. But if you did that, you'll find that Africa's growth will go down by almost as much as 1%. If it's lower than that, it's currently about 41, then this figure will be much lower. And that's the kind of drop you see in Nigerian growth, 1.5, 2.7 Angola, Chad 2.25, Gabon, Republic of Congo. So all these countries, which are factor-driven economies, are seeing a huge impact, a major impact from the drop in the oil price. So to conclude, global spillovers, are really the key to understanding how growth in Africa will be sustained going forward. And what's really important is how the domestic policy response pans out here, how the policymakers respond to it. As I say, what I'm seeing in South Africa and Nigeria is not encouraging at the moment. So there are various channels of transmission, with different degrees of impact. And understanding the channels of transmission really helps the policymaker and us understand how to craft the right responses to ameliorate or to cushion this impact. And finally, clearly, thinking about sustaining growth means that we should care about global responses, and the domestic response in terms of policy response to those shocks is key. Let me stop here and take any questions.
Okay, well, thank you very much. I take away already 3 lessons from his talk. We have to be conscious how interconnected Africa is going to be, or has become, and how we need to understand transmission channels properly. Domestic policy responses are definitely very important, and the experiences already documented show it, and we'll need to just understand how different countries are having the appropriate domestic policy responses. And I think the 3rd lesson is by his book. But anyway, so we have quite a reasonable amount of time, about 20 minutes for questions. So let me take 3 questions, comments. Anyone who wants to push it into specific examples, countries, feel free to do whatever you want with the questions. Yes, please. There's microphones coming. So let's take 3 questions.
Thank you very much. And I wanted to ask, how about the human capital aspect of, as a potential transmission in terms of corporate culture and all this, how to do business? And I haven't seen this being covered in your lecture. And what's your comment on this potential channel?
Okay. Any other questions? James on that side, the other side there.
Take 3 at a time?
Yeah, take 3 at a time, unless we run out of steam.
So most people live in Asia. How has the rise economically of Asia made Africa more or less vulnerable to fluctuations in the global market.
Okay. And there's one on that side.
I just want to get your views on inflation targeting in South Africa, especially given that the Reserve Bank is always being lashed at by the unions on inflation targeting while we have growth problems in the country. And it seems as if monetary policy is always in contrast with our economic growth.
Okay.
Let me start with that one. The monetary policy rule in South Africa is really follows an narrow inflation targeted approach. The band is 3 to 6%. So anytime the inflation goes above that or outside the band, the authorities react. That's why last week they reacted and increased the policy interest rate to 7%, because inflation is just gone just above 6%. And the unions are always protesting, say, look, this is anti-growth. What is really required is to have a kind of Taylor type policy rule which takes into account the economic activity, employment, but the output gap as an overall measure of that. I've even argued to say, look, the monetary policy rule should be expanded to include this financial stress index, which I presented earlier, because I think it's an issue. In a sense, the tension between the unions and the monetary policy authorities really reflects some deeper issues in South Africa around unemployment. That really is about the failure of the economy to create jobs. So monetary tightening is seen to be just anti-jobs. So anything that's anti-jobs, they'll go after it. And it's something that will take a while to resolve. There are many reasons why South Africa is not creating jobs. It's partly because of the unions themselves. It's the sense in which the economy, there's over-unionization, and the labor market is inflexible. You can't fire people easily. I can't remember in 4 years that I was dean of Wits Business School, how many times and how much time I spent at the labor court, because some lecturer had taken the university to the court for this and that, and you have to go there and defend the university, and that was quite unusually hard. So that is the issue. It's about jobs. It's about jobs, and it's a problem. And I don't think South Africa can easily raise its growth rate to over 5%. I think that it's stuck at the 2.5%, at best 3% level, and that's not going to create jobs. I can go into job creation strategies. That's whether those have worked or not. I've looked at those, but I can do that if you want me to do that. Now, as to whether Asia is making Africa more vulnerable, there's a sense in which Africa is vulnerable to China, specifically. You can see from my global spillovers that the most impactful countries are China and India. Those are 2.4 billion people already. so that's exactly right. And the channels of transmission are through the commodity channel, the direct trade channel. For South Africa specifically, China has become an important trading partner. But for a lot of the African countries, China is an important trading partner for commodities, but also a source of foreign direct investment, linked to commodity, investments, as well as investment in infrastructure. In fact, our prognosis is that this infrastructure, commodity, kind of linked investment model is going to come under pressure, and African countries are going to feel the pinch in terms of FDI into resources or infrastructure. So clearly, there's some vulnerability there. But I don't think, I think the issue really is how African countries should have responded to when there was a commodity boom. They missed the commodity super cycle completely by mismanaging the revenues from natural resources, and also just failing to diversify the economies. To be fair, Nigeria has done a decent job at that. We have seen the growth in the agricultural sector relative to the oil sector. Adesina, current president of the African Development Bank, he did a good job of that. There's some vulnerability there. In terms of the human capital issues, how to do business, I always think that Africa has a shortage of entrepreneurs who can take real big risk. There's no shortage of the survivalist entrepreneurs. There's so many SMEs. Africa is the largest number of SMEs for any economy of this size that I know. SMEs contribute easily 25% of the GDP in West Africa, very, very easily. And also the trade across borders an equal figure. But you don't have the large, risk-taking entrepreneurs who can take big risk and yeah.
Okay.
I'll stop.
So more hands coming up. So we have 4 in a row here. So yes, please.
Morning, Prof. I'm Flora Kurasha from the University of Cape Town. My question is about an African growth model. I don't know if you could speak to that. So I'm looking at, for example, how Europe basically grew from industrialization. Asia has been mainly through technology. Is there a growth model that you think will work for Africa over the next 25, 30 years?
Hello. Okay.
Last year, UN held a big conference in Addis Ababa called Finance for Development, and I want to hear your view in terms of the outlook of the capital flow to Africa in the coming decade following this conference.
Okay, cool.
Thanks. Actually, what you described seemed to be like a sort of perfect storm with the big deceleration in growth in China, Brazil growth turned negative, euro dead in the water, commodity prices way down. All that seemed to spell a big slowdown, certainly for South Africa. And then I seem to remember work 3 or 4 years ago from the IMF showing that there was a big spillover from South Africa to the rest of sub-Saharan Africa. I don't know if you're finding that. They were sort of claiming, sort of 1% down in South Africa, 0.5% down across sub-Saharan Africa. So my question is, if that's all right, so the prediction is really a big impact on decelerating growth in sub-Saharan Africa, then we turn to the policy responses, and it sounds from what I can see that the right response is really to have an accommodating monetary policy and let the exchange rate go. And that means in the process, you get some inflation. You've got to have some inflation to adjust relative prices, basically, if tradables have got to get a lot more expensive relative to non-tradables. So is that what should be happening? And if so, does it mean that inflation targeting is actually quite an impediment to African? It's become an impediment to African growth. Now Africa's got into a phase where it needs depreciating currencies.
Let's take a final one. Yeah. Dick was there as well. That side. No. And then we'll come back at the back later on. Yeah.
Dick Duraval, University of Gothenburg. I suppose exchange rates policy will be very important here for most important policy response maybe. So I wonder if you have anything to say about the exchange rate policy in countries that don't have inflation targeting. Then I was a bit curious about the financial stress index that you showed. It seems to be gone back, so there's no financial stress in the longer term.
Oh, it is. Okay.
Things are fine now.
Okay. Right. If I can respond, and I'll just do it back to front. Now, what should be the exchange rate policy? The exchange rate policy, in my view, under these circumstances, is do nothing. If you're a policymaker, don't try to fix the exchange rate like what Nigeria is trying to do. In any part, I'll also refer to what Paul is trying to communicate here. Let the exchange rate absorb the shock. That's part of the channel through which the shock has to be absorbed. You get some inflation in the short run, of course, but it is what it is. I do not think that the policymakers should try to target the exchange rate. It is a mistake. You just grow gray hairs if you try to target the exchange rate. Now, looking at as to how countries should respond now, which is Paul's question. When you've got slowing growth globally, the policy response should be monetary easing, but we are getting the opposite. In Nigeria, of course, I must admit monetary policy is easy, but the exchange rate is fixed, and that's a mistake. So what's going to happen is that the parallel market for the naira is going to keep growing, and is hurting, the fixed exchange rate is hurting competitiveness. It's not obvious that it is helping industry at all to me. And to keep that fixed exchange rate, there's pressure to keep using whatever foreign reserves. You've seen the foreign reserves in Nigeria have dropped in the last couple of years from something like almost 50 billion to just below 30 billion. So you have to use your foreign reserves to do that. And the moment the market watches your reserves dwindling, they put pressure on your parallel market, that parallel market official rate keeps growing. So quite clearly, the policy response pole is the wrong one, in my view. For South Africa, and you link it back to the question about South Africa and the unions, I'm also not sure that raising interest rate right now is the right thing to do. I think if I were the authorities, I would have done nothing this round of the MPC meeting last week. Easy monetary policy, let the currency take the pressure, take some inflation, because that's the only way you'll have a bit of growth. Again, because you can't just be focused on inflation targeting, Paul. There has to be some growth aspects here, because growth is your problem. And I can assure you that if you raise interest rates and growth slows down further, that will create even more problems for your sense of the equilibrium exchange rate going forward, meaning that your currency will get even more overvalued going forward. Now, on the outlook for capital flows, we are going to see a slowdown in foreign direct investment around resources, no question about that. So FDI is going to come down, and this is the resource sector that's driving that. But you won't see a decrease in remittances. As a percentage, actually, remittances, those are quite stable. In fact, I don't think we're capturing all the remittances, actually. There's a lot of unofficial remittances that are not captured. In terms of portfolio flows, you're having an outflow out of South Africa, out of Nigeria, out of Kenya, out of Egypt. And out of even the BRIC countries, they're seeing an outflow. Capital is coming back into the developed markets because they're just showing less risk, even though they have lower growth, which is this capital allocation puzzle, which Bob Lucas started about 1990. Some capital is going the wrong way because of risk considerations. Is there a model for growth for Africa? Not every country is the same. There's a growth model for each country, but there's no growth model for Africa. But think of it this way. You can think of a group of countries, maybe factor-driven countries, those that have natural resources. Quite clearly, their future growth model has to be linked to how you use those natural resources and diversify the economy out of that. Absolutely. There are countries without natural resources, like Kenya, for example, although they're discovering things now, I must say. But that's a manufacturing sector story. It's a services sector story. It's an agricultural sector story. So fragile states in terms of a growth model there, it's about fixing institutions first. But those with natural resources, again, is doing the right thing in terms of managing natural resources. So there's a different model for different types of countries. There's not a single country, but much depends on the initial conditions now in the structure of the economy now. Someone said that if you want to see what Africa will look like, look at what India is trying to do. India is not quite a country, it's a continent for all practical purposes. Maybe look at India and see how that is maybe Africa will look at that. But clearly resources are the story here.
Good. Can do definitely one more round. We are there. There was two questions waiting, and then we'll do these two here.
Okay. I understand that Nigeria currently seems to be in a fix in terms of monetary policy.
Nigeria?
Yeah. So, I mean, currently, I know the Monetary Policy Committee meeting is ongoing. So, and I understand that it seems to be in a fix in terms of monetary policy choice, given the difficult circumstances in which they find themselves. So, I'm wondering if you think capital control, in order to curb some sort of speculative inflows and all that, is the best option for Nigeria.
Okay, we take that one there, and then we'll come to the front again. Yeah.
Yes, thank you very much. Moritz Paul from the MPhil here in Oxford. I'd like to draw your attention to migration and the effect on growth right now in Africa, both as a drain towards Europe, as a refuge from terrorism, from groups like Boko Haram, but also in relation to the Syrian crisis. Is there any notable movement from Syria to Africa, actually?
I haven't seen any.
Hi, Andrea Presbitero, IMF. At one of your first slides, you mentioned, you talk about Eurobonds and issuances. So that there is now some concern about rising debt in Africa. What's your view in light of the fact that most countries still have to finance scaling up of public investment infrastructure, and at the same time, all you have discussed about commodity prices effect and second round effect on debt?
We'll take behind you there, and then we'll go back to you.
Yes.
Later on.
My concern is I want to stay on the domestic factors, and one of the issues have been the political system in South Africa. Looking at what has been happening constantly with member of parliament wearing red garments, disrupting parliamentary sessions and other behaviors. For instance, the president constantly being heckled in parliament. So I want to know your take on what is the effect of the domestic politics on South Africa's economy.
Again, I'll answer back to Fran. The effect of the politics, it's raising the risk premium quite clearly. I think that there's a way, the markets do feel that, and investors do feel that there's some leadership challenges, corruption, nepotism. Of course, it's easy for anyone in power to say it's the opposition making those claims, but I think there is some evidence of that. It doesn't help that the Minister of Finance is being pursued by some investigative unit, an arm of government. It would help if that investigation was handled differently, certainly not in public. So there is some political risk quite clearly, and it is impacting on the economy. As I said, it's as if now monetary policy is the only instrument left to try to deal with everything, to restore credibility. And raising interest rates, in fact, will kill growth. In other words, if you don't fix the politics, you end up running out of instruments eventually, because how can interest rates go without really hurting the economy and growth? So, absolutely. Our hope is that in the next couple of years, there's still a couple of years to go, actually, in terms of the next election. I don't think there's nothing we can do about that. So it's continue to be a challenge. Then on the Eurobond issues, effect on public investment, this is serious. Looking at the case of Mozambique with the tuna bond, because quite clearly they can't pay. There's going to be a technical default, in my view. They have to roll that over. If you look at the debt levels in terms of external debt, that is rising. So public investment is going to suffer. There's no question on that. And the limit of trying to use domestic public finances to invest in infrastructure and so forth, it's there. There is a limit. So quite clearly, public investment is going to suffer going forward if these countries cannot raise money globally. I must say that there's something to learn from what Kenya has been doing with a targeted domestic infrastructure bond, for instance. That may be the way to go. For those countries that have got decent capital markets, is to issue, debt domestically and hope that there is enough to finance infrastructure. But Kenya has also been trying to be very careful about making sure that when they raise those monies, they are for specific projects, maybe 5, and the public knows what those are. So there's very transparent commitment process, and they're able to report on that progress. So I've heard the critics as well say that, look, it's not happening, there's this and that going on, but at least there's an attempt. But quite clearly, the market, Eurobond market, is going to hurt any desire to raise money for public investment. In terms of migration and terrorism, there's no question that terrorism is a serious security issue in some parts of Africa, in East Africa, now in the whole Sahel region, coming down all the way to Cote d'Ivoire. That's a spillover effect from the global terrorism issue. Absolutely, it's going to hit, tourism, foreign direct investment, absolutely. But in terms of just migration and its impact on Africa, the remittances figure of this 50 billion, which I mentioned, is a product of remittances. But also you have remittances from within Africa itself. In fact, half of the remittances are within Africa, is Africans in different countries of Africa sending money back home, as opposed to Europe, US, or wherever. So there's some upside to this migration. My view has always been, let the people migrate. I don't think of, brain drain doesn't worry me too much, I must admit. Should Nigeria introduce capital controls? I don't think that's the first order of business. I think the first order of business is to deal with this issue of a fixed exchange rate, an appropriate response in terms of monetary policy. I'm not too sure that the authorities are taking the right line there. I hope I'm not upsetting my fellow Nigerians in the room by saying that those who are in government. It's not the first order of government. I think if we're talking about capital controls, having allowed the exchange rate to float, it would be a different story. Then I would look into it. But as it is now, the parallel market is developing, the oil price is not rising fast enough. You're using valuable foreign reserves to defend the currency and so forth. I'm not sure that capital controls are the next steps in terms of policy.
Good. We have time definitely for one more round. I think Elizabeth was waiting.
Thank you, Elizabeth from the University of Cape Town. My concern is for the banking sector in South Africa, and I noticed that it's one of the components you use to construct your financial sector stress index. So I'm not sure what proportion of the index is driven by the banking sector itself, because there are concerns in South Africa that the banking sector is too strong, even for the central bank itself, and for the activities like of the past few years where we had the near fall of the African Bank, we could see that that was choking households. But we also get the sense that the banking sector activities actually choke the private sector growth. So I'm not so sure what your say would be on that, given that the banking sector for South Africa actually spreads across Africa, going back to the question that he raised, the effect of South Africa's on financial sector activities to the rest of Africa as well. Thank you.
Okay.
Thank you, Prof. Olan Lovia from Wits Business School. My question is around the commodity supercycle that African economies failed to capitalize on. Do you have specific policy recommendations that these countries should look into? And I think an interesting dimension to the commodity story is that some of them are actually non-renewable and depletable.
Sorry, what?
Some of the commodities and primary commodities are non-renewable, and some of them will be exhausted at some point. I think that poses a new set of challenges for those countries who naturally have depended on those. What sort of policies are we looking at? And then talking about the cyclicality of the commodity prices, I think looking at where we are right now, I would imagine we're at the bottom of the cycle, and definitely there's going to be a time that we're going to see the cycle boom again. What can these countries do to take advantage of that? And finally, you spoke about the spillovers of shocks in the global economy to Africa. What do you think will be the spillovers actually from Africa to the rest of the world, especially given this economic cycle? Thank you.
Any more hands? Okay, so Mthuli, just last two.
Right. Let me try to deal with this. On the financial stress index as to the component from the banking sector, what is that? I'm capturing that through two variables. One is the credit stress, and the other is this money market spread. That's how I'm capturing it in the index. Now those two The others are much broader, non-bank financial activity indicators in terms of bond activity and equity market activity. Now, is the banking sector too powerful, too strong? I think really it's not about being powerful, it's about being uncompetitive and being just colluding, frankly, and not being interested in broader financial inclusion. I think I think that is partly true. I think the issue of collusion in the pricing of products, it seems to be an issue. I've got an earlier piece of research on that, which shows, proves that a bit of competition would do. I think an economy of that size with only 4 banks, really, it sounds like too few banks. And then number 2, of course, now we have got the entrance of Capitec from the bottom, and that has been due to the gap that the 4 big banks have left in terms of the bottom of the pyramid, financial inclusion. So there's an issue here. So if you're looking at the FSI index, then it's about how much credit and where this credit is going. Perhaps that's the link there, but I don't think it's strong enough in terms of the choices, business choices of these banks. I've even argued that perhaps there's need to really push on the financial inclusion front. Nedbank tried. I know that they tried to introduce M-Pesa in South Africa, and it failed. And the reasons, one of the reasons that's been given has been the attitude of the authorities. They feel that this technology-driven, a credit channel and banking channel is not subject to I mean, it poses some risks, but I don't think it is, risky as long as you follow a bank-driven model in mobile banking. It's an area that I've looked at. As long as you follow a bank-driven model, I don't think there is risk. I know that the IMF at some point was complaining to Kenya about M-Pesa and saying, look, this is causing monetary policy shocks, inflation, and all of that, and then the systemic risk issue. But I don't think so. So the central bank in South Africa, I think, has not been pro-inclusion in that sense. It's a view I have. Then on the commodity super cycle, the policy recommendations, I think the horse has bolted. Prices are already down. So the countries have to deal with this aftershock. Of course, they can't get around the fact that they have to focus on managing the revenues from the commodity sector, absolutely. Whether it's sovereign wealth funds or whatever, some mechanism, clean and clear and transparent for managing revenues is critical at whatever price, even at the price of $41 per barrel. And those revenues have to be utilized for the usual 3 areas. One is to support current government expenditure, investment in infrastructure, and something in the kitty for future generations. I don't think we can get away from that narrative. But at $41 compared to $100 a barrel, we have lost a lot of value there, unfortunately. But I must say that there's also a fixation in the resource sector for countries to try to build refineries. I mean, there's a big talk about a refinery in East Africa, and countries were competing where to locate this refinery for the oil and all of that. A refinery is very expensive. I don't know many refineries that make money. They lose money. They consume a lot of power. I don't know whether that's the first order of business. There's much to be achieved in the commodities sector, in mining, by building supply chain networks around that industry. For instance, think about companies that make helmets and boots and so forth for mining, the catering sector, the transport and logistics sector around moving the ore from wherever it's mined to wherever it's headed. There's a lot of business that you can build around that, and that's what South Africa has done successfully, and not in building refineries to beneficiate. I'm not convinced by that strategy. Did I miss something? Oh, spillovers from Africa to the rest of the world. I think what I saw was the impact of a bit of the impact of the strike in South Africa on the gold price and the platinum price and so forth. Maybe that commodity channel as an issue. But I can also see, an impact through any sort of collapse in supply from a country like Angola or Nigeria or something on the oil sector, that impacting oil prices. It hasn't happened yet, but there's always Saudi Arabia to balance these things out. I mean, that's the kingmaker here. So maybe through the commodity channel, one can see the impact of the African, growth spillovers into the rest of the world. I'll stop here for now.
All right. I think, we've run out of time. It's time for coffee. I think we should maybe just end the session by thanking Mthuli for his contribution and an interesting debate here. Thank you.
Thank you.